Hi everyone, welcome back to Corporate Decoder. Today we're diving into the financial report of New England Realty Associates. This one's got a real estate twist that might leave you feeling a little, foreclosed. This report gives us a peek into how this real estate partnership fared in the first 3 months of this year. We're talking revenue, expenses, and a whole lot of numbers that tell the story of their business. Before we get started, if you enjoy breaking down corporate reports, make sure you're subscribed to stay in the know. We also have a Discord community linked in the description below. Come join us. New England Realty Associates, or NERA, they own a bunch of properties in Massachusetts and southern New Hampshire. We're talking apartments, mixed-use buildings with stores and offices, and even some commercial spaces. This is a Form 10Q, which is basically a quarterly checkup for publicly traded companies. It's not as detailed as the yearly report, but it gives investors a good idea of how things are going. This form includes all the typical legal and financial info like the file number and contact information for the company, but we're going to skip straight to the fun part. First up, let's take a look at the consolidated balance sheets. It's a snapshot of what the company owns, assets, and what it owes, liabilities as of a specific date. Think of it like a financial selfie. Their rental properties, the big money maker, are valued at roughly $283 million as of March. That's up from $278 millions at the end of last year. This means they've either bought more property or the value of what they already own has increased. ORES seems to be swimming in cash, or at least they had about $31 million in cash and short-term investments, more than $17 million at the start of the year. Here comes the interesting part. They owe a hefty $405 million in mortgage notes payable. It's down a bit from December, but still a massive number. In all, total liabilities are $456 million. In simple terms, NERA owes more than the value of their properties. This can be a yellow flag. High debt can be risky. Next, we got the consolidated statements of income, also called profit and loss statement. It's basically how much money they made and spent over a period of time. Rental income is up to $20.5 million for the quarter, compared to $19.7 million a year ago. It is a solid increase, but it needs to be compared to expense increases. They spent almost $621,000 on administrative and $3.9 million, quite expected for a real estate company. The management fee, which goes to the Hamilton Company, is $818,000. Operating expenses took $3.3 million. It's what cost them to run the buildings on a day-to-day basis. They also spent $2.9 million on repairs and maintenance. Real estate requires constant work to keep it good. After all of this, they have an income before other income, which is $6.2 million, an increase from $5.7 million in the prior period. They made about $1 million in interest. This is revenue from holding cash. However, they burned about $3.8 million on interest. That is a big hit. Their income from joint ventures, those shared investments, brought in $363,000. After all of this, NERA's net income or profit landed at $3.8 million for the quarter. That equals to $32.53 per unit, which are from about $29 per unit from last year. There is also a consolidated statement of comprehensive income that we will not dig in detail. Basically, it adjusts the net income with items that are unrealized to reach comprehensive income. Then there is a consolidated statement of cash flows. This statement is often a good indicator since it follows the actual cash that goes in and out. Cash from operations, which is about $5.5 million, is solid. This means that NERA's core business is doing well and converting revenue into cash. A significant sum came from investing activities, $21 million. This number might be related to a purchase of short-term treasury bonds. This number might be related to selling of those same bonds. This is for their ongoing Woburn construction, which we will discuss more in a second. They burned cash for financing of approximately $13 who owned the company. In all, their cash is up to $13 million. There are some notes that we will scroll to now to help put this in perspective. These are important because they lay out exactly how they do their accounting and how management makes estimates on certain key values. It goes on and talks about their revenue recognition, how they depreciate, all the normal things you see here. We won't dig into all the nitty-gritty accounting details, so let's move on. Diving into the debt, most of the loans are secured by first mortgages on their properties. Interest rates are in the 3%, 5% range, and they're making monthly payments that adds up to $1.6 million. This section talks about how much they think their assets are actually worth compared to what they're listed for on the books. It's all about fair value, and some of it's a little subjective. They provide equity method investment statements so we can understand joint ventures with other investors. This section confirms that nothing major is going on as far as lawsuits or big liabilities that aren't already on the books. They don't have any big messy lawsuits, so that's good news. This is where things get interesting. After the quarter ended, they signed a deal to buy property for $175 million using a lot of short-term funds and short-term instruments. This is a potentially significant undertaking. This has a high potential to make or break the year. Let's take a step back and look at the bigger picture. They state that they do not have a single tenant that accounts for 5% of the partnership's revenue. That can be either a really good thing because your business is very distributed, or a very bad thing, which means that no one wants to do business with you. There is this disclosure: the partnership's management, with the participation of the partnership's principal executive officer and principal financial officer, has evaluated the effectiveness of the partnership's disclosure controls and procedures were effective. This is pretty standard stuff and is mandated by regulations. And finally, we see the signature of the principal executive officer, Ronald Brown. So, what's the verdict on New England Realty Associates? Well, their revenue is inching upwards and they're sitting on a decent pile of cash, but they are also heavily burdened by debt that are going to cost them a lot of interest. But hey, that's pretty common in the real estate game, right? The key thing to look out for in their next report is how they manage the new $75 million in the real estate game, right? Kimes they can tell to grow revenues for the partnership. Now it's your turn. What do you think NERA is doing right, and what are they getting wrong? Is it a buy, sell, or hold? I'd like to know what you think in the comments. If you found this video helpful, leaving a like really helps the channel. Be sure to subscribe if you haven't yet. Also, make sure you check out our Discord channel in the description. There are so many great conversations going on in the channel. Thanks for watching, and I'll see you all in the next one.